Hello and welcome back. Until now, we've covered several subjects, such as real estate market cycles, the overall commercial real estate market, the cash flow analysis using net present value, and the internal rate of return IRR. We've covered direct capitalization. We've covered effective tax rate. We have covered lease versus purchase through the eyes of the net present value, through the eyes of the internal rate of return, and we have done sensitivity analysis for the lease versus purchase. So today we will discuss basically the effect of leverage on your investment, and we'll look at what the purchase price should be to achieve your desired yield. I'm your host, Brian Shakarami, and let's get started. Everyone knows that there are two certainties in life, taxes and death. There are also two certainties in investment real estate, taxes and debt or leverage, both of which can have a significant impact on the rate of return that you obtain on your real estate investment or your yield. So how does debt affect your investment? Also, when you purchase an investment real estate, you might have a yield or rate of return in mind, and you may wonder, how much should I pay for this investment to achieve my desired yield? So what should my purchase price be? So when purchasing your investment real estate, you have two decisions to make financially. Whether you should purchase your investment in an all-cash deal, or whether you should make an initial investment and finance the rest, in which case you'll be using leverage. The good news is whether you purchase your real estate in an all-cash deal or whether you finance it, you would still be able to use the cost recovery recapture in real estate. So now you have some financial criteria to consider. For example, if you are purchasing it in an all-cash deal, then you need to know your investment amount. And you would definitely want to know the internal rate of return before and after tax. You would certainly want to consider and know what your cash on cash is, both before and after tax. You should know what your effective tax rate is. Most people want to know what their cap rate is right off the bat. And oftentimes this is used for their initial decision-making process. You may want to know the gross rent multiplier. If you're financing, you may want to know about your cost of funds. When you buy your real estate, you can buy it, but it doesn't have to be all your own money. So if you finance, there will be some initial investment amount that you'd want to consider. If you finance, you'd want to know what your discount rate is, what your interest rate, weighted average cost of capital, and yield is. They all have a direct impact on your investment. And of course, all the other criteria that we considered for cash purchase, such as cash on cash or gross rent multiplier, and so on. Let's discuss some new terms that we had not referred to in the past, such as cash on cash. What is cash on cash? In a nutshell, it's the return on your initial investment. It's the return on the cash that you put down. And this can be obtained for before and after tax. It is calculated as the first year's cash flow before tax divided by your initial investment. That's your cash on cash before tax. By the same token, if you have your first year cash flow after tax, and you divide that by your initial investment, you will have your cash on cash after tax. We mentioned gross rent multiplier, or the GRM. That's basically the number of years it takes for your property to pay for itself, and to pay for itself using potential or gross income. This is obviously another tool you use for evaluating the property that you want to purchase. So let's talk about gross income, or your potential income. This is basically the income that you receive. It doesn't include vacancies and credit losses. It doesn't include other incomes or collectibles, and it does not include the operating expenses. it is definitely missing a lot of consideration. And it's calculated as the purchase price divided by your potential rental income of the first year, or your first year's potential income. Now, I have said a lot of things here, but to make you understand the real effect of borrowing and taxes, and to give you a better understanding of what I'm talking about when I say what price to pay for a desired yield, it is best to drive our point home, or our points home, with an example. And our example is about, again, one of our president's buildings called Trump Mahal. So in this example, we will look at its purchase, operation, and sale. Trump Enterprises, a cash-rich company, is looking at a commercial office building to add to its portfolio, to be called Trump Mahal. Mr. Trump wants to know whether he should purchase this building in an all-cash deal or whether he should use leverage in this transaction. For now, he's planning on holding to the building for the next 5 years, if he were to purchase it. He has a desired yield of 9%, meaning he wants a 9% rate of return at least. Mr. Trump wants to know what criterias he should consider in order to make a sound financial decision. You're tasked to help Mr. Trump with his decision. What will you have him consider to ensure that he makes the right decision if you don't want to get fired? So the property information is provided. Purchase price, acquisition cost. They provided the first year's potential income and the escalation rate for this income or rent. They've provided vacancy and credit losses. There are no other incomes such as perhaps telecom towers, which you would get extra rent for. Other income growth rate, therefore, is 0%. Operating expenses for year one is provided, and they've provided escalation rate on the operating expenses. The land allocation is 20%, which means your improvement is 80%. And your disposition cap rate at the end of year 5 is 7%. Disposition cost of sale is 3%. This is for year 5. To the right side here is the investor assumptions, such as the tax bracket for Trump Enterprises and their desired yield or targeted yield. Below is the financing assumptions. You have an LTV ratio of 75%, a DSCR of 1.2, an interest rate or discount rate of 5.5%, amortization years of 20 years, and a loan terms of 10 years. There are 12 payments per year, and the Trump Enterprises pays a discount point of 1%. There are also third-party costs of $3,200. How would you analyze this, and what would you show Mr. Trump? We are going to consider 4 scenarios. One is obviously an all-out cash purchase, and we will look at this all-out cash before tax as well as the after-tax scenarios. By the same token, we will look at a leveraged purchase scenario before tax, and we will look at a leveraged purchase scenario after tax. And of course, for all of them, since Mr. Trump has a certain yield in mind, he desires a certain yield, we will figure out what price he should pay to purchase this property given that certain yield, to ensure that he meets his yield or rate of return. However, before we do this, I want to back up and discuss a new term that was introduced in the financing side, and that is DSCR. This is the debt service coverage ratio. It was provided in the financing assumptions, and it was 1.2. It's the relationship between the NOI and the annual mortgage debt service. And that debt service is the principal and interest. Basically, it's a ratio. First year NOI divided by the annual debt service. The DSCR is one of the ways to calculate the loan amount. Generally, the banks do this, or financial institutions do this. The second way of calculating the loan amount is the LTV, or the loan to value. And generally, the loan amount is the lesser of the two. In other words, when they do an LTV and let's say it comes out to $10 and they do a DSCR method and it comes out to $9, then they loan you the lower of the two amounts, which would be $9. So let's look at our cash flow analysis if we were to make a cash purchase. As you see, we have the potential rental income. We've subtracted the vacancies and credit losses, and we've therefore arrived at our effective rental income. Since we did not have any other income or collectibles, our gross operating income, or GOI, is the same as our effective rental income. From there, we subtract our operating expenses, and we have our NOI, or net operating income. Normally, if our property was leveraged, we'd subtract the interest on the mortgage, whether we had a first and a second mortgage. And of course, we'd subtract the cost recovery or the improvements. This is a commercial property, so therefore we do the improvements for 39 years for depreciation. From here, we calculate our real estate taxable income, and given our tax bracket, we will have our tax liability, which is calculated below it. Down below our net operating income on line 17, which comes from basically line 7. And since we did not have any financing, there is no annual debt service. So our cash flow before taxes is the same as our net operating income. And if we were to deduct the tax liability from line 16, we will have our cash flow after tax. So therefore, line 22 is our cash flow before taxes, and line 24 gives us our cash flow after taxes. Moving on to the alternative cash sales worksheet, we calculate our adjusted basis of sale, which is basically the acquisition minus that cost recovery. Based on the sale price and the cost of sale and the cost recovery, recapture, or depreciation, we find what the capital gain from appreciation is. Since there is no mortgage, after all, this was a cash purchase, our sale proceeds before tax is just our sale price minus our cost of sale, and that is $76,555,310. Moving on to the sale proceeds after tax, we'd have to subtract the ordinary income tax, the recapture tax, and the capital gains tax, all of which are depicted here. And lo and behold, we have $71,259,659. I just wanted to show you how we arrived at some of these numbers that we will use to do our analysis with in the following slides. Here's our financial analysis on the cash purchase for both before and after tax. Remember that our desired yield was 9%. Mr. Trump strictly wanted a minimum of 9% desired yield. Therefore, we do our analysis based on a 9% discount rate. So here we start with our initial investment, in which case this is a full price because we did it cash on both sides. And we have the cash flows from our cash flow analysis, both for before and after tax on the right. And we also have the sale price, both for before and after tax. When we run the numbers, our internal rate of return for before tax is 14.55%. However, for the internal rate of return after tax, it's 11.81%. The net present value given that desired yield is $13,658,631. That's before tax. What this means is that we can still afford to pay an additional $13,658,631 for this property when we purchase it and still make our 9% yield. Same thing for the after-tax effect. We next move on to our cash flow analysis for our leveraged purchase scenario. As you can see, this is basically the same analysis under a cash purchase scenario, with a couple of exceptions. Here we have deducted the interest on the first mortgage because they only had one mortgage, and we had to amortize the loan costs for this mortgage. Basically the only difference here. So to arrive at our cash flow before taxes, we have our NOI line 17, which we got from line 7, and we subtracted the annual debt service. And lo and behold, we have the cash flow before taxes, from which we subtracted the tax liability of line 16, and we came up with our cash flow after taxes. As before, we moved to our alternative cash sales worksheet, and a major difference here was the mortgage balance. So therefore, our sale proceeds before tax was $41,196,294. This is because we had to write off the mortgage balance at the end of year 5 because we've decided to hold the property for 5 years only. And the rest is the same as the cash purchase scenario. There is another difference here between this and the cash purchase scenario. To do our financial analysis, we need to know what our initial investment is. And right here to the right, our initial investment is derived from the purchase price, added to it the acquisition cost and the loan cost, and we subtracted the mortgage. And lo and behold, we came up with our initial investment. In this case, $15,523,200. And we start with our financial analysis, again, using a 9% discount rate or desired yield that Mr. Trump wanted. Here's our initial investment for both scenarios for before and after tax using financing, our cash flows before and after tax here, and our sale price for before and after tax. For the leverage scenario, our internal rate of return before tax is 30.48%. Our internal rate of return after tax is 25.51%. Our net present value before tax is $18,769,262, which means that Mr. Trump can afford to pay an extra $18,769,262 to purchase this building and still make his 9% desired yield. Now let's do a comparison of the leverage versus cash purchase before and after tax. Looking at the cash purchase, IRR, internal rate of return before tax, 14.55%, after tax 11.81%. However, if we borrowed money, that 14.55% before tax would almost double to 30.48%. Our rate of return doubled because we use leverage. The scenario for after tax would have been 11.81% for a cash deal and 25.51% for a finance deal. Our rate of return with financing after tax is more than double our rate of return with no financing on a cash deal. Huge difference here. Now let's look at our cost of funds. We borrowed $42 million. Our discount rate or interest rate was 5.5%. Amortization was 20 years, but our loan term was 10 years. We paid discount points of 1%, and we had third-party loan costs of $3,200. But we only kept the building for 5 years, which means at the end of 5 years, we paid it off. What was our real cost of financing, or what was the real cost of funds? So again, amortization of 20 years, a loan term of 10 years, but we only really kept it for 5 years. What was the real cost of fund? What was the real cost of borrowing? What was the real percentage or the discount rate? So in order to calculate the real cost of funds, we will start with our periodic payment. If we were to have this loan for 20 years amortization, our periodic payments would be $328,360. That's principal and interest. And if we were to pay off this loan at the end of year 5, our balance is $35,359,016. We have to figure out net loan amount, and that is our loan amount. We subtract what we paid for in discount rates because you paid for it in cash, so you subtract it. And you also paid for third-party loan cost of $3,200. So your net loan amount is $41,576,800. So now that we know the loan amount, which is the present value, we know we held it for 5 years, we know we had 12 payments per year, we know that our future balance at the end of year 5 was $35,359,016. We know our periodic payment. All we have to do is to calculate that interest rate or discount rate, which is our real cost of fund. Lo and behold, for before tax, our cost of fund is 5.75%. So even though our discount rate was 5.5%, after we paid the discount points and the third-party loan costs, and after we kept the loan for 5 years, our real cost of capital came out to be 5.75%, not 5.5%. So in summary, our effective tax rate for the cash purchase came out to 18.83%, whereas the one for a leveraged or finance purchase came out to 16.31%. So we have a better effective tax rate under a leveraged purchase. Our cash on cash under a leveraged before tax scenario was higher than the cash purchase. However, this cash on cash was a little higher under a cash purchase scenario for after tax. Our cap rate was calculated to be 9.51%, almost 9.5%, and our gross rent multiplier came out to 6.49. That's almost 6.5 years to pay for this property. If you compare the before tax yield for a cash versus leverage scenario, you will see that once we use leverage, our yield increased 109%. For our after-tax scenario, our yield increased 116%. Using leverage has given us a huge increase on our yield, as noted here. It takes money to purchase a property, but it doesn't all have to be your own money. You can use leverage, and by doing so, you can increase your yield. In conclusion, we have analyzed the leverage effect, we analyzed the tax effect, we analyzed the purchase price given a certain desired yield, and we analyzed the cost of funds. As always, if you have any questions regarding what we just discussed, please send me an email to the following link and I'll be happy to get back to you. Thank you for your time.